Hello traders, welcome back to the channel. Today I want to talk about one of the trades that we have on in the Income Navigator service. This is a 112 bear trap that has become very popular in not just ours but in many other communities. You may recognize the risk profile, and this is a trade that we put on 5 days ago, and we would assume that for a trade that starts out positive delta, positive theta, and negative vega, if the market went up and the time has passed and volatility has fallen, we would expect to see some profit in this trade. However, this trade specifically has been on for 5 days. The underlying, or SPX in this case, has moved up about 1/2 of 1 standard deviation. So nothing crazy has happened, but the market is moving higher and volatility has compressed a little bit. However, the trade is showing a loss of $450. So just looking at the Greeks here, we would assume that for every 1 point S&P goes up, our delta is positive 18. We would expect to make about $18, $20 per point. That did not happen. Every passing day, we should expect to make about $620, maybe $630. We've been in this trade for 5 days. Where's my $3,000? That didn't happen. And volatility has fallen just a little bit, and we would expect that a trade that has a negative 24 or 2500 vega, we would make about $2,500 for every 1 point that volatility falls. We can look back on the chart, and this is not probably the exact volatility readings, but we can get an idea that when this trade was put on, let's just call this vol was at 11, and right now the vol is somewhere between 8 and 9, so let's call this 8.5. Right, volatility has fallen about 2.5 points. Well, we should make about $2,400 for every 1 point volatility falls. Where's the money, right? Let's talk about what happened. So the Greeks, and I'm not here to tell you that the Greeks are lying to us and that it is useless or this is fraud. We live and we die by the Greeks. But the Greeks are just telling us half of the story. The Greeks are here to tell us what we would expect, right? How we would expect the pricing of our options to change given the passage of time, price change, volatility change, and so on. In this case here, 5 days has gone by. The market has gone up a little bit, volatility has fallen, but none of the Greeks have reacted the way we would expect them to react given this current scenario. Let's go back and take a look at what actually happened just by looking at the pure P&L of the options that are part of this trade. Now, 112 is set up in the way where we are long one out of the money option. We are short one more out of the money option. This makes it a debit spread. And then we're short 2 further out of the money options to finance the purchase of this put debit spread. So in a sense, we are short 3 options and we're long only 1 option here. Now we can just go back and look at this specific trade. We are long 46.75 put. We're short 46.25 put. This is a 50-point wide put debit spread. And then to pay for this put debit spread, I am short 2 times as many contracts as I am long contracts on the put debit spread of the 42.75 puts. And in the tool that I'm using here, we have several different metrics that we can look at. Here we're looking at the P&L. So this is going to tell me the price change from what I paid or what I collected for any given option here and what the P&L net result is so far in this trade. So for the long 46.75, right, I'm losing about $6.28. For the 46.25 put, I am making about $4.38. We can just do some very basic math here. So if I am, right, let's take 623 minus 433. This is a difference of about $1.90. So net I am losing about $1.90 for every one put debit spread. I have 10 of these on, so I am down about $1,900 on the put debit spread. So let's mark that minus 1,900. Now we go down lower. I am short 20 of the 4275s, and my net change in this option is plus 70 cents. So I'm making 70 cents times 20 contracts. So I'm up about $1,400. So I'm making $1,400 on the short out of the money puts that are naked. And I'm losing $1,900 for the put debit spread that I am long, which gives me a net P&L for this trade minus 500. So what happens here is that even though the Greeks are telling us that if the price is going to move in the right direction, which is up for us in this trade, the time is going to pass whether you want to or not. We can't control that. So positive theta means we're going to make money with every passing day. And the Vega, which is short, we would assume that we would make money from decrease in implied volatility. Doesn't always going to work out that way. What happens here is with the end of the year and end of the year markup, whatever you want to call it, Santa rally, Powell rally, whatever it is, for whatever reason, right? The market's moving higher. Whoever wants to sell premium, they would need to sell premium that's closer at the money. As we know, right, the theta and the implied volatility will be higher, closer to at the money. So if you are not necessarily buying premium right now, chasing this rally, but you want to sell out of the money premium, right, the risk premium, you want to sell something, it is more advantageous to sell something closer at the money than farther away at the money, because at this point in time, I think if we look at the term structure of implied volatility, the term structure is now relatively flat, meaning that implied volatility closer to at the money is now going to be closer and closer in value as the implied volatility for the options that are out of the money. So if you were to sell something right now, you probably want to look to sell something closer at the money. That's where you get the most bang for your buck. And in this case here, the value of our put debit spread is falling faster than the value of our short out of the money puts. And that is causing a net negative effect instead of net positive effect, as we would expect from this trade under normal circumstances. I also think that setting up 112s right now could potentially be a good idea. However, I think going forward, or at least for the next couple of weeks and into the next year, I think that setting up a 112 the way we normally would set it up with a nice credit up front is not the most advantageous thing to do. I think it probably makes more sense to start trades with less credit up front, a little more potential reward inside the trap. And if the market does revert and volatility will quote unquote normalize, I think we're going to see value of the put debit spreads increase a little bit faster than the value of the short out of the money puts, and this is going to work in our favor. I hope I didn't confuse you guys. If you have any questions, feel free to post them below. As always, take care of the risk. Profits will take care of themselves. And if you are trading 112s right now and you are experiencing losses, or maybe you're not seeing the profits you thought you would be seeing with these trades, do not be alarmed. I think things will come back to normal inside of the next couple of weeks, maybe the beginning of next year. Until then, trade them well. We'll talk to you in the next video.